Let me start with this. All it takes is $25 a week. That's it. Skip one takeout meal. Cancel a subscription you barely use. For most people, it's an amount that comes and goes without much thought. But invested consistently, that same $25 a week has the potential to grow into a portfolio worth more than $800,000. One capable of generating over $5,000 a month in dividend income without selling a single share. I know that sounds hard to believe, but I'm not asking you to trust me. I'm going to show you the math, step by step, so you can verify it yourself. The goal is simple. Build enough investments that your income keeps coming in even after you stop working. And today, we're starting with just $25 a week. With an amount that small, there's one strategy that stands above the rest. DRIP, or a Dividend Reinvestment Plan. It works like this. When you own shares of certain companies, they pay you a portion of their profits as dividends, and most investors take those payments as cash and spend them. Instead, you're going to reinvest every dividend to buy more shares. Those new shares earn dividends too. Those dividends buy even more shares, and the cycle repeats. That's the power of compounding. At first, the growth feels slow, but over time, those small gains begin building on each other, and the results become surprisingly powerful. Let's put some numbers behind it. Imagine a stock trading at $20 a share, and you own 100 shares, and the company pays a $1 annual dividend for every share you own. At the end of the year, you receive $100. Most people would spend that. Instead, you use it to buy 5 more shares. So now, you own 105. The following year, you don't receive dividends on 100 shares. You receive them on 105. And those dividends buy even more shares, which generate even more dividends. Year after year, your income grows because your ownership keeps growing. You didn't work longer hours. You didn't find the next hot stock. You simply let your investments pay for more investments. And over time, that small snowball becomes much larger than most people expect. There's another advantage here too, called dollar cost averaging. Instead of trying to predict the perfect time to invest, you buy every single week. When prices are high, your $25 buys fewer shares. And when prices fall, that same $25 buys more. Without realizing it, you're buying at a variety of prices instead of betting everything on one moment. And that takes the emotion out of investing. You don't need to watch financial news, panic during crashes, or wonder whether it's the right time to buy. You just stick to the plan. And over the long run, consistency has historically beaten trying to time the market. The final benefit is automation. Once you've set up automatic investing and dividend reinvestment with your broker, the process takes care of itself. Every dividend is reinvested. Your weekly investment continues on schedule, and your portfolio keeps growing in the background while you focus on living your life. Now let's make it even better. Reinvesting dividends is great, but combining that with regular contributions is where compounding really begins to accelerate. In this example, that's just $25 a week, about $100 a month or $1,200 a year. Like I said, every weekly contribution buys more shares. More shares generate more dividends, and those dividends buy even more shares. Each cycle builds on the last, and over time, the growth becomes exponential. The best part? The only secret is to stay consistent. So what should you actually invest in? Well, there are thousands of stocks to choose from, and it's easy to overthink it. But the good news is, you don't have to. Instead of hunting for the perfect stock, focus on 4 simple categories. The first is blue chip dividend stocks. Large, established companies with long track records of paying dividends, like Coca-Cola, Johnson & Johnson, and Procter & Gamble. They're not exciting, but that's exactly the point. They're built for stability. The second category is dividend aristocrats. To earn that title, a company must have increased its dividend for at least 25 straight years, which means they've kept rewarding shareholders through recessions, crashes, and economic uncertainty. Businesses with that kind of consistency have proven they can handle hard times. Next are high-yield dividend stocks, which pay above-average dividends and give you more income for every dollar invested. They can carry more risk, so they shouldn't make up your whole portfolio, but they're a valuable addition when balanced with steadier holdings. And finally, there are dividend growth stocks. Companies that don't just pay dividends, they keep raising them while growing the business, giving you the potential for rising income and long-term appreciation. When choosing investments, I like to keep one simple rule. Look for companies that check at least 3 out of those 4 boxes. That one filter cuts most of the noise and leaves you with businesses that have strong fundamentals and a history of rewarding shareholders. Using that approach, here's an example portfolio. NextEra Energy, Starbucks, Abbott Laboratories, Home Depot, and the ProShares S&P 500 Dividend Aristocrats ETF. Together, these give you a healthy balance of dependable income, consistent dividend growth, and long-term appreciation. No portfolio is guaranteed to outperform, but this mix shows the kind of diversified, dividend-focused approach that many long-term investors aim to build. Now comes the question everyone wants answered. Can $25 a week really make a difference? Let's run the numbers. Imagine you invest $25 every week, reinvest every dividend, and stay consistent for the long term. After your first year, your portfolio won't look impressive. It'll be worth around $2,500, and that's normal. But after 10 years, it could grow to roughly $27,000. After 20 years, around $145,000. And after 30 years, that same habit has the potential to grow into a portfolio worth more than $820,000. By then, because your dividends grew far faster than the share prices did, the income those shares throw off compared to what you originally paid for them climbs to around 7 to 8%. That's roughly $63,000 a year, about $5,200 every single month, without selling a single share. But here's the part most people overlook. Over those 30 years, you only contributed about $36,000 of your own money. Everything above that came from market growth, dividend increases, and the power of compounding. Your money kept earning money, and then those earnings started earning money too. Now, I already know what some of you are thinking. 30 years? I don't have 30 years. So let me show you what actually changes this math. Because it isn't time, it's the number you feed it. Everything I just showed you ran on $25 a week, but the plan doesn't break if you give it more. It just gets bigger and gets there faster. Double it to $50 a week. One extra dinner out that you skip. And that same 30-year portfolio grows to around $1.6 million, throwing off more than $10,000 a month. Push it to $100 a week, about $400 a month, and you're looking at over $3 million and north of $20,000 a month in income. Same 5 investments, same strategy. The only thing that changed was the amount. And here's what kills the 30 years is too long excuse. More money in doesn't just mean a bigger finish. It means you hit every milestone sooner. At $100 a week, you don't wait 20 years to cross $145,000. You cross it in about 12. You feel this working long before the finish line. 30 years is just where the snowball gets ridiculous. But the real wins start showing up years earlier. And if $100 feels out of reach right now, that's fine. You start where you are. $25 gets you moving, and you turn the dial up as your income grows. The plan scales with you. Of course, none of these are guaranteed results. Markets go through recessions, crashes, and years where returns disappoint. So some years you'll beat these numbers, and others you'll fall short. The key is staying invested through all of it. The people who succeed aren't the ones who find the perfect stock or time the market perfectly. They're the ones who keep investing even when the headlines make it feel uncomfortable. That's why consistency matters more than timing. The math has worked for generations. The biggest variable isn't the market, it's whether you stick with the plan. So if you've been telling yourself you're too late, or that you don't make enough money to invest, hopefully this changes your perspective. You don't need thousands of dollars to get started. You just need to start. And for many people, that first step is only $25 a week. If you're ready to learn how to build this into an even larger dividend portfolio, I'll show you exactly how in the next video. So subscribe and turn that notification bell on. I'll see you in the next one.